Good morning, happy Friday. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. China's lopsided recovery. Factory growth moves up a gear, but consumption unexpectedly slows. Chinese officials hold urgent talks to address the property crisis. Stocks retreat as traders reassess the path forward for interest rates, with more Fed officials warning lending costs will stay higher for longer. Plus, JP Morgan CEO Jamie Dimon tells Bloomberg he's still more worried about price pressures than markets appear to be, citing inflationary forces ahead. We bring you more from that interview. Let's check in on these markets then. On a day when on Wall Street there was a bit of a pullback. Yes, the Dow Jones briefly crossed above that 40,000 level for the first time. The S&P, though, coming back below that 2,300 level. A bit of a breather coming through for these markets that, of course, have worked so much to add those gains year to date. And again, pairing some of those gains by the end of the session yesterday. European futures pointing low by 0.4%. Markets repricing then around the Fed once again from two cuts just a day or two ago to one cut right now. The Chinese data as well, a concern arguably for the European markets, particularly when it comes to the health of the Chinese consumer. European futures then pointing low by 0.4%. FTSE 100 futures here in the UK pointing to losses of around 0.2%. S&P futures currently flat after modest losses yesterday. Nasdaq futures 18,657 also flat. We've been hearing from Jamie Dimon on his views everything from China to geopolitics to inflation. Take a listen.
I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise.
JP Morgan CEO Jamie Dimon, of course, on his views that maybe inflation is being still underpriced by these markets. Let's look cross-asset then, as we see, of course, you did see a bit of a movement in terms of yields edging higher on the 10-year yesterday. Today, the 10-year is currently unchanged at 4.36. Again, Jamie Dimon is saying that longer term, the headwinds that could keep prices elevated remain structural changes, particularly around things like renewable energies and the shift to more military spending. Euro dollar, by the way, at 1.08. And as Isabel Schnabel of the ECB suggests that, yes, you may get a cut in June, but don't bank on July as a cut. Not warranted at this point. Concerns about over-easing from the ECB being flagged by Schnabel. Brent, $83.53, up 0.3%. And copper continues to grind higher, 10,429 on that industrial metal. Currently flat in the session, but the gains continue to come through. Let's cross over to Asia now. Avril Hong standing by in Singapore for a breakdown. And it's a busy Friday for you, Avril. What's standing out to you?
Oh, let me count. So many things at play here. First, it was the Fed narrative, Tom, and then we got China data. I mean, Asia stocks were already in negative territory as the expectations of Fed rate cuts were unwound. We saw those declines, and then we got the China retail sales number, that big miss despite industrial production accelerating. And so we're seeing this in Chinese equities. The CSI 300 slipped into negative territory. The Hang Seng initially was in the red, but has managed to eke out some gains now. I think it speaks to how sentiment-driven the Hong Kong markets have been of late. But let's take a closer look at what else we're seeing. Flip the board if we can. And it is really about the property sector. That's the heart of the issue related to the Chinese economy. And it wasn't just retail sales and industrial production numbers that we got. It was also home price data. And that was a deeper contraction than the previous month. And I think it speaks to how the fundamental issues, they haven't been fixed. Indeed, we have the likes of Morgan Stanley today downgrading the outlook for the real estate sector as they flag that, hey, these physical market issues, they haven't been resolved. And we also have, if you remember the report about how we could get some of the excess inventory resolved, that plan proposed might actually disappoint. So this is what we're seeing. Despite that, we're seeing the Chinese stocks and bonds, they've been climbing. It's really about the expectations of policy support. Flip the board, because I also wanted to take you through what we're seeing in China bonds, because of course that's been a focus as we have the special bonds going on sale today. Those are the 30 years. And of course, the idea here is to raise funds for government spending. It was a pretty solid auction, 4 times the demand of what was on offer. But of course, as we look at the currency moves, the yuan has been weakening, no thanks to the China data, but also the Japanese currency, a bit of a double whammy for the renminbi. Tom.
OK, Avril Hong, thank you very much indeed in Singapore, with a check, of course, on the Asian markets, with the read across, of course, when we're thinking about when it comes to the Federal Reserve, but also, of course, the China data. More lines crossing right now, and Avril Hong was referencing these. Senior officials meeting in Beijing from some of the key regulators to address the property crisis. And here's the redhead crossing someone right now. China will be removing the mortgage rate floor for individual home buyers. The context is that in recent years, up until 2 to 3 years ago, Chinese officials have put in place restrictions on home buying because of the what was once a red-hot property market. Now they are undoing some of those restrictions, and the latest move then is removing the mortgage rate floor for individual home buyers. There may be some stress on the banking sector as a result of this, but the idea is that you can see lower mortgage rates to encourage consumers and house buyers, potential and prospective house buyers, to go out there and buy up some of these houses, of course, and the prices continue to drop. And we've seen that in the most recent data. We've also heard, of course, more recently that cities like Hangzhou have started to remove all curbs on property purchases. Let's get the details then, the reaction. Well, Jill Deese is standing by. He's been monitoring this for us. Jill, walk us through what we've been hearing in terms of the response from senior officials in Beijing to try and finally put a floor under this property crisis. How potentially significant could these moves be?
Yes, Tom, I think, obviously they could be significant here. We're still getting some details on what exactly this ultimately means. We're seeing they're lowering the minimum down payment ratio for first-time buyers to 15%, second-time buyers to a little bit more. So at this point, we'll ultimately see where that goes. But thanks for putting this in context, Tom. I mean, this is all part of this broader package of, that's up for discussion about what the government needs to do to ultimately put a floor under this, at this point, years-long property crisis. Bloomberg had obviously just reported a couple of days ago that there are additional measures that are under consideration to sort of help the housing market. Maybe that means, state-owned enterprises in local areas take out, sort of state loans and buy up properties from distressed developers, turn that into affordable housing. That's something that we had reported maybe under discussion just a couple of days ago. So I think the totality here, Tom, is that it really does mean that there's just additional measures that they need to take to sort of, put a floor under this property crisis, as we were just discussing with this China data. I mean, look, this is, as you said, this is a two-speed recovery, right? Manufacturing is doing really well, but look at domestic demand. It's still really, really struggling, and that's in large part because of the property crisis.
Yeah, the two are very much interlinked, as you rightly say, the squeeze and the softness in the property market and the linkages to the consumer. What does that tell us then, Jill, about the assessment now as to the policy response, the support that many would argue is needed in form of some type of stimulus to support the consumer? Can we expect that to be stepped up?
Well, Tom, I mean, we're obviously talking right now about the potential for some of these additional, property-related measures. I think that can be read as some form of support. But in terms of large-scale stimulus, it does still seem unlikely that you would see some type of massive package as you did, about a decade or so ago. I think that, at this point, the government also wants to see how other types of measures that they've been taking sort of transmit into the economy. We just had a couple of hours ago the beginning of a sale of these special ultra-long government bonds to sort of fund, infrastructure-related projects and stuff like that. We just had the initial kicking off of that sale happen this morning. That's obviously going to be happening throughout the rest of the year. Again, the idea being that that would primarily fund probably infrastructure-related projects to really spur activity and growth within the economy. We'll see what else ultimately happens. Maybe that takes the form of additional rate cuts throughout the rest of the year, something else to sort of spur demand. Because as we've been talking here, Tom, I mean, demand continues to be an issue. It's not just the retail sales figures that were released today that were, more depressed than what a lot of economists were expecting. It's also some, fairly weak, very anemic CPI numbers that just came out fairly recently. There's a lot here that, continues to drag on that segment of the economy. When it comes to the consumer, we'll have to see how that ultimately results in additional support from the government.
Jill Deese, excellent context. Thank you very much indeed. And wrapping some of these redheads and breaking lines around this support that comes through from Beijing. We'll see how material that is. Jill, thank you. A redhead also crossing the terminal, and this is around Prosus, that of course is and houses much of the internet assets of Naspers, and also has a significant stake, of course, in China's Tencent, which of course is the company behind many of the most popular games in China. It's the pipeline for those games, but also the WeChat app as well, the so-called super app. Prosus naming a new CEO, Fabrizio Bloisi. Fabrizio Bloisi is going to be the new CEO of Prosus from July the 1st, replacing Irvin Tu, who's been at the helm since September of 2023. So change at the top there. Irvin Tu stepping down. He's been at the helm, the CEO of Prosus since September of last year, and a new CEO taking charge, Fabrizio Bloisi taking charge. We'll see how the stock reacts to that, of course, at the start of change at 8 a.m. UK time. Let's get to the geopolitics of China and Russia now, pledging to intensify cooperation against what they call US containment. The two countries agreed to greater coordination, including between their militaries, in opposition to Washington's, quote, destructive and hostile course. Speaking after he met with Vladimir Putin in Beijing, President Xi also outlined his position on the war in Ukraine.
China and Russia agreed that a political solution to the Ukraine crisis is the right direction. China's stance on this is consistent and clear.
OK, let's bring in, at this point, Bloomberg's EMEA News Director Ros Matteson to get the latest. And Ros, we expect to get pictures, I think we're seeing pictures, we will do shortly, of Putin speaking live in the northern city of Harbin, not far from the Russian border, symbolic as well, given the history and the linkages between Russian culture in that city and, of course, that Chinese city. Talk to us about what we've been hearing in terms of Xi's views on the conflict in Ukraine and to what extent that aligns or not with Vladimir Putin.
Well, it's really important to see the recognition again of that, quote, no-limits friendship this week between China and Russia. That's been important for Vladimir Putin with his war in Ukraine, because what China has done is they're not explicitly endorsed the war in Ukraine, but they've not overtly criticised it either. They're taking that stance of it's your business, just don't let it get too messy and too out of control. Don't draw us in too much. And in a way, some Chinese companies have benefited from the war in Ukraine because they're now the buyers of last resort for Russian commodities, so they can negotiate good prices for themselves. So there are some wins potentially from China from this, but really the stance has been it's your business, just don't draw us too much into it. But that's important for Vladimir Putin on the global stage, to have that sense of like some sort of Chinese backing, especially against the US. They get this idea of Russia and China together countering the US, countering the West, be it on Ukraine or other issues.
The rhetorical support, the trade support, the economic support, of course, from China coming through and being reiterated then in this meeting. We continue to see live pictures, of course, of the Russian president speaking there in Harbin. We'll monitor that for you. This also happening, of course, at a time many would describe as a pivotal moment, potentially, for the conflict on the ground in Ukraine. Russia making some significant gains. What is the latest on that front?
Well, they have been doing that offensive again in the northeast, and that's around that major city, Kharkiv. And it seems like it took Ukraine by surprise, even though Russian troops had been massing in that border area for some weeks. But certainly they're making progress in some smaller towns and cities in the area. Can they take Kharkiv? Unlikely at this point, given their resources. However, what they're doing is they're just stretching the Ukrainian resources. We know Ukraine's been, suffering a lack of artillery, ammunition, manpower, air defence, and Russia's probing all the way along the front line at this point, particularly in the northeast, to see how it can stretch those resources further and then how can it maximise. So certainly making some progress around the northeast. That could extend south as well into Ukraine, because ideally at some point Russia's priority probably is the southeast. It wants to get further along the Black Sea area, Odessa being a main port in that area. So is this sort of drawing resources, Ukrainian resources, to the northeast, then Russia can come into the south. So certainly we're seeing signs of small breakthroughs along that entire front line. OK, and we're hearing as well Zelensky has been on the ground in Kharkiv with his military commanders as well, as of course they address some of those concerns, or look to address the probing by Russia. Ros Matteson with the context, of course. Thank you very much indeed in terms of the conflict on the ground in Ukraine, of course, of what we've been hearing from Putin and Xi Jinping. Coming up, China announces new property measures. We're going to get the take from Ning from the Shanghai Advanced Institute of Finance, an advisor as well, informal advisor to the PBOC. Plus, Formula One world champion Max Verstappen speaks to Bloomberg about growing the sport and the recent personnel changes at Red Bull Racing. We bring you that interview later in the show. This is Bloomberg.
Welcome back. Happy Friday. Welcome back to Bloomberg Daybreak Europe. We had some really important lines crossing from China out, of course, of officials meeting in Beijing to try and address the property crisis there. Some of the most significant moves coming through to date to address the slowdown, of course, in the real estate market of China. And some of the lines now, the detail, China will be removing the floor on mortgage rates. It's also lowered the minimum down payment ratios for individual home buyers. Again, being characterized as the most drastic move so far to kind of shore up that property market. So they're cutting the down payment ratio for first-time buyers to 15% and cutting it to 25% for second homes. This, of course, after property prices, sales, I should say, fell the most in a decade, and property prices continue to be squeezed in China as well. So how effective will these measures be? Very pleased to say that I'm joined right now by Ning, Professor of Finance at Shanghai Advanced Institute of Finance and also an advisor to the PBOC, at least an unofficial advisor to the PBOC and a number of other governing bodies in China. Professor, thank you very much for joining us. Give us your reaction to these measures then. Is this going to be enough, do you think, in your opinion, to put a floor under this property market? How substantial, how significant do you think these measures will be?
Well, I think the first take is I think these are very helpful measures, compared to the policy that we have been having in the past year or two. And I think it's also very important, a significant signal to the market that what the government is changing its channel or the priority of the policy making. So from just leaving the real estate to itself to, I think it is trying to put in some of the floor to the property market. I think by lowering the interest rate or by allowing a greater portion of the housing prices to be paid through mortgage, this is really providing some incentive for the home buyers to consider the real estate market again. However, I think for the moment, I do not think that is sufficient to attract enough buyers to stabilize the market for two reasons. One is I think the housing market is still relatively sluggish, especially given the high prices relative to the income or relative to people's expectation of where their income will be. I think it's still quite expensive. I think the more important thing is over the past 3 years or so, housing prices have been coming down, not going up. And as we know about the bubble theory, people tend to buy assets only when they see a great potential of making money, not losing money. So as long as that expectation is not changing, I do not think the softening of the lending requirements or the reduction of the mortgage rate will have a significant impact on how people and households perceive the housing market in general.
OK, that's really, really interesting context, Professor. The other key proposal that came through, it is still a proposal, it seems, but we're getting a bit more detail on it, is a proposal for local governments to buy up excess inventory, unsold properties, unsold units, for local governments to buy those up. How significant could that be? And to what extent is this shifting the debt load from the real estate companies to local governments and state-owned banks?
I think this is a little bit similar to the bailing out of the financial institutions going through the great financial crisis. So in a way, I think those real estate developers are already in a fairly dire situation. So without the government stepping in, it is very likely that almost all the private real estate developers will go into distress, I think, by the end of the year. So I think in a way, it is probably an option that has to be taken for some kind of government credit to support the real estate sector and the real estate developer. That being said, I think we're talking about trillions of RMBs worth of real estate on the market. So whether the local government will have enough resources to build all those vacant or apartments to be finished, I think that remains to be seen. There's another logistic challenge, which is how do we make the distinction about whether you should buy up this project versus the other ones? There will be some rent seeking and there will be some moral hazard issues in the implementation of the policy. So in a way, I think it is encouraging to see the local government stepping in to stabilize the market. But I think in the end, unless the central government is stepping in and extend its own credit to the real estate market, it is a little difficult or a little too premature for us to believe that we're out of the woods. I think there's still a lot of empty and unfinished projects on the market for the moment.
Okay, really interesting. We also, of course, had some significant economic data crossing today from China, and the consumer seems to be still challenged, and we can probably tie that to the real estate sector as well. Professor, there's an argument for some that China needs to shift from investment-led growth to consumer-led growth. Do you buy into that argument, and are steps being taken to get to that point?
Yes, I have been a very strong advocate for the transition from the investment-driven to the consumption-driven growth model in the past decade or so. I think real estate has been a very hindering factor in the past decade because real estate has been crowding out the household consumption because just so much money has been poured into buying the apartment and servicing the mortgage. Unfortunately, I think we're seeing the flip side of the story with the softening in the housing market. Even though people probably do have more disposable income at the moment, they're also losing the confidence that their houses will be more expensive in the future than now, or their jobs will be paying more than they did in the past. So I think we're talking about a transition, but this is not an easy transition. I think for that, the government has to be more committed to providing both social welfare programs and some of the incentive or stimulus or subsidy.
Professor, unfortunately, we've run out of time, but really, really smart analysis, as always, on this China story. Ning, Professor of Finance at Shanghai Advanced Institute of Finance. Thank you. Plenty more coming up. Stay with us. This is Bloomberg. This week, President Biden announced new tariffs on billions of dollars of Chinese goods. The US leader sharply raised levies on clean energy imports, including batteries for solar panels and electric vehicles. I'm joined now by Andy Leach, associate in Bloomberg NEF's energy storage team. For some of the details around this, the context more broadly, Andy, are these tariffs then going to help kickstart, because this is part of the rationale, the battery industry in the US?
So the United States has been importing an increasing number of lithium-ion batteries from China. So this is around $3 billion a quarter at the moment. And this is in part due to the fact that China has a large advantage in the battery manufacturing capacity. And there have been massive drops in prices in battery manufacturing, so 40% prices that we've seen over the last year. And this is in reaction to that. As well as the stick approach of increasing these tariffs, there's also been incentives. So the Inflation Reduction Act is bringing a lot of incentives to try and build the battery manufacturing industry. And we've seen over $100 billion of investment since this act was passed just under 2 years ago. As well as trying to increase the amount of battery manufacturing capacity, there's also a push to go upstream. One of the things that the US has been doing is putting a lot more money into battery recycling. So once these batteries are imported, they can be recycled within the US to produce US-made batteries in the future. Okay,
that's interesting. We're trying to create a closed-loop system when it comes to the recycling of batteries. Talk to us then about the broader implications of that and the demand picture right now in an EV market that seems to be softening.
Sure. So at the moment, out to 2030, we expect that different battery metals, say between lithium, nickel and cobalt, which are the key battery metals, around 10 to 18% of the demand in 2030 can be met by recycling. This is different by different metals and by different regions. So lithium, for example, this number is around 10%. This is because lithium is in pretty much all the batteries going into grid-scale applications as well as EVs. And for nickel and cobalt, this is slightly higher. This is because nickel and cobalt are not used in, for example, lithium iron phosphate batteries, so LFP. And this type of battery is becoming increasingly popular with EV manufacturers.
Really interesting. Andy Leach, thank you very much indeed with some of the details around what this could mean for the build-out of battery capacity and, of course, the recycling element as well in the US. Andy Leach, associate in BNEF's energy storage team. Thank you. There's plenty more coming up. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. Happy Friday. I'm Tom Mackenzie in London. These are the stories that set your agenda. China removes the floor on mortgage rates and cuts minimum down payments in a drastic move to prop up the beleaguered property sector. We bring you the details. Stocks retreat as traders reassess the path forward for interest rates, with more Fed officials warning lending costs will stay higher for longer. Plus, JP Morgan CEO Jamie Dimon tells Bloomberg he's still more worried about price pressures than markets appear to be, citing inflationary forces ahead. We bring you more from that interview. We are getting lines crossing on the earnings front from Richemont, of course, the luxury retailer with a focus on the jewelry business and demand out of the US and China. Full year sales coming in just very marginally below the estimates. Full year sales for Richemont, because we're getting the full year and the quarterly numbers. Full year sales coming in at 20.6 billion euros, 62 billion euros. The estimates had been for 20.65 billion euros, so just slightly below in terms of the full year sales versus the estimates. The operating profit is a miss for Richemont for the full year. Operating profit coming in at 4.79 billion euros. The estimates had been for 4.83 billion. It is a miss on full year operating profit for Richemont. We know the luxury space has been challenged in recent quarters. Sales at a constant FX rate up 2%. The estimates had been for an increase of 7.7%, so well below the estimates on an FX constant basis in terms of full year sales. And they are naming Nicolas Boss as the CEO of Richemont, effective June the 1st. So June the 1st is when you're going to see change at the top for Richemont, with Nicolas Boss becoming the CEO, effective at the first day of that month. We're, of course, looking for the details around the China exposure, particularly Cartier, and also watches, because, of course, you had that pandemic boom in terms of the demand for luxury watches. That has softened. To what extent is that weighing on sales for this company? The Americas revenue coming in at a constant FX rate, up 5%. So America's doing relatively well, increase of 5%. The estimates had been for just north of 3% in terms of America's revenue. Japan revenue coming in well above the estimates. Japan is performing well for Richemont, up 20%. The estimates had been for 12%. Asia-Pacific region as a whole, though, and China will be the drag here, you're looking at revenues up 10% versus the estimates of just shy of 14%. So that is some detail crossing from Richemont. We'll get across this story and bring you more detail just in the next couple of minutes, of course, on that story. Let's check in on these markets then, as we, of course, continue to assess the comments coming through from FOMC officials suggesting that even though CPI this week came in softer and came in at the coolest level that we've seen in 6 months, they continue to see rates higher for longer. We had that reiterated from a number of Fed speakers overnight. European futures down 0.4%. The China data as well, also a concern for some investors in this part of the world, with the consumer continuing to feel the pressure in China. FTSE 100 futures currently pointing up, down by a little shy of 0.2%. S&P futures currently flat. NASDAQ futures also in similar territory. A bit of a breather coming through for these markets after the solid run they've had, of course. The S&P had crossed back above that 5,300 level for the first time, I should say, currently pointing at 5,319. Let's flip the board cross assets. We saw a bit of move higher in yields on the benchmark 10-year, currently at 4.36 on the 10-year. Euro dollar at 1.08. The Schnabel of the ECB suggests that you may get a cut in June, but not necessarily in July in terms of the sequencing. $83 a barrel on Brent, up 0.4%. And copper continues to grind higher, up 0.3% so far in the session, 10,458. Let's cross over to Asia. Avril Hong is standing by, and wow, it's been a busy Friday, Avril. What are you looking for?
Yeah, we're looking at the Chinese property sector in the past 30 minutes or so because, of course, we got those PBOC lines that they're scrapping the nationwide mortgage floor. This is for individual home buyers, first and second home purchases. They're also lowering the down payment ratio. So these are the most drastic measures I think we've seen in a way to tackle the real estate sector woes of late. Of course, it's also coming in a week where, as Bloomberg reported, authorities are mulling a proposal that would see local local governments kind of mop up the excess inventory of unsold homes. And it is about how these policy support expectations have been supporting the property stocks as well as bonds. Take a look at the gauge of developers in Hong Kong and how they've fared since the month of April, that lows, and they've climbed about 50+% since then. But let's flip the board and take a look at what is that faring or how that's playing out for the equity space today. It's not really moving the needle, this latest announcement. The CSI 300 still about 0.2 lower. This is what we saw before those lines dropped. The Hang Seng also pretty flat. I think we need to see a bit more meat on the bones in terms of policy support for the property sector here. Don't forget, this is on a day where the retail sales number really disappointed. Industrial production accelerated. But the takeaway for investors is these supply-demand imbalances for the Chinese economy, that the consumption, the demand picture is really not holding up. And this is already on a day where the retracing of the gains from yesterday was underway as investors recalibrate their expectations of Fed rate cuts. Let's flip the board and take a look at some of the other assets that we're keeping an eye on in China, because today we also got that special bond sale, 30 years. That demand was pretty solid, all things considered, but you're still seeing the ultra long end of the curve, and that's still coming under some pressure. Maybe that concern about oversupply. Now, dollar China has been higher today, not just because of the China data. Think about also the external environment, those tensions between the US and China, Tom.
OK, Avril Hong, thank you very much indeed in Singapore. Wrapping in the geopolitics, but also, of course, the measures coming through to support the real estate market in China. At least that's the help, but with the focus as well on the weak consumer in that country. Avril, thank you. Now, JP Morgan CEO Jamie Dimon says the US has to stay engaged with China on that topic. Speaking to Bloomberg at the bank's Global Markets Conference in Paris, Dimon says Washington and Beijing have common interests and are not natural enemies.
So the geopolitical situation is very tense because of Ukraine and Russia, Iran, the terrorist activities in Israel, North Korea, nuclear blackmail. We've never had nuclear blackmail before, and this is, of course, affecting our relationship with China. And, it's going to be hard to have a great relationship with China as the Ukraine war is on. We're kind of on different sides of that, and put Taiwan aside. Having said that, I think it's the right thing for America to fully and deeply engage with China, competitively. Every nation is going to do what's in their own interest for national security. So should America. We should define that fairly and properly. If there's unfair trade, negotiate that or do whatever you need to do. But the engagement is the right thing to do. China is not a natural enemy of the United States. They have a lot of their own problems. So, to me, we could work together as best we can. And then we have common interests: climate, anti-nuclear proliferation, anti-terrorism.
But what does it mean for a bank working in China, actually, given all of this volatility?
They're cautious. I mean, China, if you look at China from a risk-reward basis, it used to be very good. It's not so good anymore because all these things can go wrong. And remember, we bank, I've got the number, but 1,500 multinationals in China. They're not leaving China, so we're going to serve our clients there. We're just much more cognizant that the risk is higher. And I put Hong Kong in that bucket, too. We kind of look at China, Hong Kong as one at this point from a risk standpoint.
What does the Trump administration mean for the U.S. economy?
I don't know.
Why? Because it's unpredictable, or because we're too soon to actually trying to figure out the policies that he would put in place?
So if you look at history, who was elected president may not necessarily affect the next year. That's kind of like we're a big tanker and that's going to happen. I think the much more important thing is what we do in the geopolitical situation. I've always been quite clear that American leadership is provided to keep the world free and safe for democracy. And that means economic alliances, which includes trade, by the way. I think we should spend more time in trade. It means NATO. It means that Russia should not win in Ukraine, because if they do, I think it can tear asunder this Western world.
I know you've ruled out being Treasury Secretary.
Yeah.
Why? What would it take to get you into politics?
I don't think I'm suited for politics. I love my job, and so I'm not sure I want to do something like that. And I can hopefully.
But even if you got the call, would it be hard to say no?
I don't know. Probably yes. I love my job, and I have no interest in leaving and doing anything else. So.
OK, that was JP Morgan CEO Jamie Dimon, of course, speaking to Bloomberg's Francine Lacqua at the Lenders Global Markets Summit in Paris. Let's bring you the latest lines then and just wrap what's been happening from Richemont, of course, the key luxury name there, with the Cartier brand and others, of course, and their exposure to China, Asia, Pacific and the US. Just correcting in terms of the FX, constant FX sales for the full year, because we're getting the full year numbers, we're getting the quarterly numbers. So just correcting a line that we announced earlier, because the numbers have been adjusted. The Richemont full year sales at constant FX rate actually saw an increase of 8%, above the estimates of 7.73%. So I make that clear that the full year sales for Richemont at a constant FX came in with an increase, a solid increase of 8% versus the estimates of 7.73%. The top line is that these earnings essentially meet the estimates. You've also had the naming of Nicolas Boss as the CEO to be leading this business from June the 1st. And in terms of the Americas segment of the business, revenue at a constant FX rate increased 5%. That was above the estimates. Japan also did well. Asia Pacific, though, as a region, below the estimates, and China will no doubt be the drag within that component. Let's get more analysis now on the Richemont story with Dasha Afanasieva, who joins us and has been looking at the numbers for us. Dasha, what's jumping out to you from these results?
Well, good morning. I think it's really the new CEO. Nicolas Boss is the chief executive currently of Van Cleef & Arpels. So he's been with the company for a while. But what's the two things I think are really interesting was that he's coming in really quickly. He starts on June 1st. And Joanne Rambert, who's currently CEO, is actually sticking around and being chief operating officer. So that's quite unusual. And that they're doing sort of a switcheroo and is now reporting to Nicolas Boss. So it'll be interesting to see if that actually brings in any changes at the helm, because, as I say, both of them are still going to be there and they've been with the company for a long time. And in terms of the actual numbers, I think what is most intriguing is the idea of Asia Pacific. I mean, we knew that there would be a slowdown on watches because there's this normalization following COVID. So that was expected. And I think we were looking to the strength of China and of Asia to see how well Richemont could weather that storm. And as you said, overall, they met expectations, but there's a bit of patchiness among the regions in Asia.
Dasha, how do the numbers from Richemont compare to the broader luxury landscape that does face some of those challenges?
Well, I think if you look at the broader landscape, LVMH, I mean, particularly Kering's been having a really tough time. And it's really sort of called into question this idea that luxury is just going to grow and grow. LVMH has done it a bit better. But if you look at the price to earnings ratio, Richemont is actually getting that premium even over LVMH now. It's got, which I think speaks to the specialist kind of niche that it's found, watches and high-end jewellery like Cartier. If you look at what the street thinks, it's got 20 buys and 13 holds and no sells. So there's this idea that maybe there's even upside in the valuation. We'll see what the shares do today.
OK, Bloomberg's Dasha Afanasieva with the results for Richemont and the broader read across to the luxury sector. Dasha, thank you very much indeed. Other stories making the news this Friday. Walmart has breezed to another quarter of sales growth and says it now expects the full year to be slightly better than expected. The big box retailer reported a 3.8% rise in same-store sales, with e-commerce a big driver, jumping 22% during the period. Walmart says higher income households drove the bulk of its gains. Shares closed 7% higher yesterday, the biggest one-day gain since March of 2020. And Bloomberg has learned that top HSBC shareholder Ping An is weighing options to reduce its 8% stake. Sources tell us in-market share sales or divesting to a sovereign wealth fund in the Middle East are being considered. We're told board members at the Chinese insurance giant are currently visiting the Gulf, but it's unclear whether formal talks are being held. On macro policy now, and the central bank's ECB's Holtzman coming out and saying that we must be sure, this is in the last few minutes, that CPI is on the path to target before we cut rates. That's from Holtzman of the ECB, of course, known to be on the hawkish end of the spectrum, saying it's too early rate cuts risk refueling inflation. Lines coming from Holtzman of the ECB, Eurodollar at 108. There's plenty more coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's take a look at the consumer space race now as Elon Musk's Starlink transforms communications across the globe. Bloomberg Originals has been looking at how its dominance is sparking government scrutiny and encouraging deep-pocketed rivals.
The largest single constellation of satellites orbiting our planet is run by a mercurial individual who needs no introduction. It's this guy. It achieves this by maintaining a vast relay network in low Earth orbit. That's the area higher than a jetliner, but below a GPS satellite.
Right now, Starlink has more than 5,600 satellites in orbit.
And it accomplished all this in less time than it took James Cameron to make a second Avatar movie.
At one point, SpaceX envisioned launching up to 42,000 satellites.
But this speed and relative success has raised eyebrows, concerned ones in government, and excited ones in the boardrooms of potential rivals.
It's essentially a company trying to disrupt a somewhat complacent marketplace.
Okay, and you can watch the full documentary on Starlink from Bloomberg Originals on your terminal, our website, of course, or on YouTube. Now to AI and developments there. Reddit surging post-market on a partnership with OpenAI that will bring its content to the ChatGPT chatbot. Shares of Reddit, which had their IPO obviously back in March, jumped as much as 15% in late trading following the announcement. Reddit will also offer its users new AI-based tools built on models created by OpenAI. Financial terms of the deal were not disclosed. Coming up, F1 world champion Max Verstappen speaks to Bloomberg about growing the sport and those recent personnel changes at Red Bull Racing. We bring you that interview next. This is Friday. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. We're going to focus now on Formula One because the glitzy motorsport has been riding a wave of commercial success, of course, in recent years, in part due to that Netflix documentary Drive to Survive. Team valuations are soaring. New fans flocking to the sport. The current world champion, Red Bull's Max Verstappen, of course, spoke to Bloomberg's Jason Kelly about how F1 needs to consider the different ways it wants to grow and how to keep those fans engaged in the sport.
It depends how you want to attract fans. Like, you can attract it, of course, in very different ways, right? From the entertainment side or actually the performance side of things. And of course, the sport has been growing a lot lately, probably from, more the entertainment side. But, you also need to question what you actually want, because I think it's also very important to keep, the real die-hard fans, really engaged. But, these kind of things, at the end of the day, I'm the racing driver. I'm very focused on my performance. And, that's already taking a lot of my time, trying to just be on top of my game, being, in touch with my team, what we can try and improve. And, to be honest, those kind of things are not really going through my mind a lot, how should I grow the sport? I mean, that's not up to me. I'm not, also the shareholder of the sport. I'm just here to try and win the races.
That's a fair point. And obviously the commercial success does, as you rightly point out, rely very much on success on the track. No one would question your success on the track. It's worth pointing out that obviously, there's going to be a big change with Adrian Newey leaving. What's your confidence level, I should say, about that side of the equation moving forward, ensuring that you can stay competitive on the track?
Yeah, I mean, it's of course, it's been quite a change, I guess, but also a shame that, Adrian will be leaving, because I think it would be always nice for him, to be part of what we are doing. I mean, he's been incredibly important for us, especially from the start of Red Bull Racing, I would say. And yeah, I mean, at one point, you have a lot of good people in the team, a really strong technical department. that I trust in as well, for the future. So naturally, the confidence is very high. I'm very excited for the coming years as well. But yeah, would it have been nice for Adrian to be around as well and see that? For sure. But at the end of the day, when people want to maybe seek new challenges or whatever, you can't stop that.
OK, that was Red Bull F1 driver Max Verstappen speaking to Bloomberg's Jason Kelly. He talked about the need for viewers to remain engaged. Some would say he keeps winning, and that's making the sport less interesting. But I'll leave that to others. Now, Wall Street Bank CEOs Jamie Dimon, David Solomon and Brian Moynihan spoke to us this week. Yes, all of them from investment conferences in France. They weighed in on the US economy and Fed policy.
The US economy is chugging along pretty well.
We've had good, healthy markets for quite a while.
There's 1,000 things that can go wrong tomorrow, but right now everything's in pretty good shape.
I think the chance of something going wrong is higher than people think.
Where it'll be in 6 months, how much of that slowdown we see in the bottom quartile, we have to watch the data very, very carefully.
Whatever the world is pricing in for a soft landing, I think it's probably half that.
Right now we have a no landing, honestly, a 2% growth rate, because you can't say it's a soft landing.
There are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect.
What the Fed is doing with rate structure is having the impact they want. On the other hand, the economy's kind of there, and now we got to be careful we don't overshoot the other way.
I think they are doing the right thing to be patient right now.
Jamie Dimon, David Solomon and Brian Moynihan, of course, speaking to Bloomberg Television this week from investment conferences in France. Let's just reflect on the moves of yesterday, because at one point you had the Dow crossing that 30,000 level for the first time, of course, in history. There was a little bit of a pullback, a little bit of a breather for Wall Street yesterday. You had FOMC officials coming out and reiterating the higher for longer, even as we saw that inflation print looking a little bit more benign. So that rhetoric continues from Fed officials. You had the S&P, of course, it broke back above that 2,300 level. You're now kind of closer now to that 2,300 level. In terms of the upside then, where we go next, where are the next catalysts for this market? It's not really coming from China, at least not for now. Let's flip the market or the board and have a reflection and have a look at what's been happening when it comes to China and the squeeze there in terms of property prices. You did see a pickup in terms of the gauges when it comes to property stocks. They've been performing quite well. You've had some additional measures coming through, but it's how those measures are implemented at a time, of course, and this links to the consumer, at a time when the consumer is feeling under pressure. They're making it easier, basically, to put down payments on properties, to go out there and buy and access mortgages. If this succeeds, you could get an improved consumer outlook for China. But that is a big if. That's the move in terms of property stocks, but with all the context. There's a lot more coming up this morning, including an exclusive interview with Paschal Donohoe of the Eurogroup, of course. That interview, 9:30 UK time. Also today, the President of Georgia will speak to Bloomberg. It comes as the country's ruling party, of course, faces those protests over its foreign agent law. Really interesting interview then at 9:10 a.m. on The Pulse. But Markets Today is up next. Stay with us. This is Bloomberg.